I read that precious metals and precious metal securities nationwide comprise between 1/3 and 1/2 of 1% of investment and savings assets in the United States. Hi, I'm Rick Rule. I run the U.S. business of Sprott Inc., a Canadian listed and domiciled firm focusing on precious metals and natural resource investments worldwide.
Hi, I'm Ken Lewis, CEO of APMEX Inc., the largest precious metals dealer in the U.S. with over 20,000 products and 1.5 million customers served. Also CEO of OneGold, a new digital product that's trying to take the next stage in precious metals ownership.
Fairly recently, I read that precious metals and precious metal securities nationwide comprise between 1/3 and 1/2 of 1% of investment and savings assets in the United States. If you go back to 1981, which was the peak of gold demand, as I understand it, precious metals and precious metals related investments had a 7% market share in savings and investment nationwide. And the 3-decade median is between 2 and 2.5%. Now, I'm not one of these who suggests that gold is going to supplant the US dollar as a medium of exchange. I don't think gold's going to win the war against the dollar. But I bet you it's going to lose it less badly. My belief is, in terms of things like the ETFs and the precious and the whole panoply of precious metals investments, that gold demand, precious metals and precious metals assets demand in the United States will go from its current level, less than 1/2 of 1%, to its 30-year mean, which is 2%. Mean reversion generates a 4-fold increase in market share for precious metals and precious metals related asset in the largest investment economy in the world. And that's what I think is going to happen.
And do you have any views that the scarcity of gold, that the amount of mining being done in today's world and the availability of gold, when we think about as demand starts to resume itself for gold at levels like we've seen in previous days, what's your view on what that does to the price of gold?
Well, I'm a believer that markets work. I'm a believer that price will take care of scarcity. Yeah. It might take care of scarcity at a very, very, very different level. If you think about a circumstance, going back to the earlier question, where gold would go from 1/2 of 1% of the savings matrix in the United States to 2%, in other words, where you would quadruple demand for gold. The gold will be there. Remember that almost all the gold that's ever been mined is still physical gold. So the gold will be there, but the price might be different. The price denominated in dollars.
Right. Well, it seems like there's a lot of upside on the prices where I was going. Obviously, if demand were to pick up to levels like we've seen in the past, with the amount of individuals out there with dollars to invest, it seems like it's a great opportunity for price appreciation in the gold space over the long term.
That's what I think investors need to wrap their heads around. Investors need to wrap their heads around how small an asset class it is and how it has been efficacious, hate to use those big words, but efficacious over time as a savings and investment product. And it doesn't mean that you have to return to a gold standard. It doesn't mean that we have to go into the Greater Depression. It doesn't mean that we have to have a Holocaust. The only thing that has to happen is that people have to be a little less confident than they are today. Explaining how that would occur would be defaulting to the arithmetic and away from the narrative. And you've answered that question. And gold could do very well. At the very least, it could protect your family's purchasing power, which is what it's designed to do.
You know, one of the things we talked about at lunch today was the upside versus the downside risk of something like gold. You know, you look at where pricing is today, you look at where it is historically, you look at where, only a certain amount of gold is coming out of the ground at any given year and where mining is on that stage. It seems to me like gold has a far lower downside and a much greater upside. Any views on that?
Ken, you're going to hate this answer. Pray for a downside. I mean, a downside means that no insurable event occurred.
Yeah.
Wouldn't it be great if your kids had life insurance on you and they never got paid?
Great point.
Which meant that your great-great-great-grandchildren could enjoy your company. Think of automobile insurance that you never collected on, which meant you never had a wreck. Think of insurance on your house that you never collected on, you never had a fire. I own a lot of gold. I own a lot of gold. And I hope the stuff goes to $400 or $500 an ounce. What it means is that everything else in my life turned out fine. Yeah. By the way, I don't think that's going to happen. Yeah. But when you talk about the upside in gold, I always tell my clients, be very cautious what you think about. That set of circumstances that could cause gold to go to $5,000 an ounce or $12,000 an ounce, while they're certainly identifiable circumstances, they're uniformly unpleasant.
Right. So Rick, what drives the price of gold and silver in today's markets?
In my experience, which is to say historically, gold moves first, and gold moves on fear. Because gold is so volatile, the fear buyer takes it to price level so quickly that the greed buyer steps in. And there's this staccato back and forth between greed and fear. Yeah. Silver moves later. Silver is the poor man's gold. So after gold has moved, silver responds. But because of its greater volatility and lower unit cost, it usually moves further. We suggest that gold is an insurance asset and silver is a speculative asset, and that customers treat them that way.
That's a good point. Well, Rick, thanks for coming in today. We do appreciate your time and all your insights.
Thank you for the conversation, and thank you for the wonderful tour of your facilities.
Thanks.